All right, welcome. Thank you everybody for joining. Just give everyone a minute here. All right, thank you everybody for joining today's webinar. My name is Julia Kelly. I'm an Associate Product Manager at Harvard Business School Online, and I'll be moderating today's discussion with Professor Suraj Srinivasan, who recently developed a course for HBS Online on strategic financial analysis. So the format for today's webinar is going to be a question and answer session. So I have a list of questions, including some that were submitted by all of you as you registered for today's webinar. And we'll also be answering questions that are submitted live today. So if you'd like to submit a question, please feel free to use the question and answer feature on Zoom. We'll get to as many as we can today. We also have some HBS Online staff members on the call who can help answer questions that come in about our courses or enrollment or anything like that. So feel free to ask those types of questions as well. And before we get started, I'm just going to briefly share a little bit of information about the Strategic Financial Analysis course. I know some of you may be familiar with it already, maybe are taking it now, but since we will be talking about some of that course material today, I just wanted to give everybody a high-level overview of what the course is about. So Strategic Financial Analysis is one of the newer courses here at HBS Online. We're really excited to be able to offer it. It essentially explores the intersection of accounting, strategy, and finance, and gives you a toolkit to better understand business performance, future prospects, and business value to make better strategic decisions. The course is 6 modules long, kind of starts out by exploring the links between strategy and financial statements. Then it gets into lots of ratio analysis and financial tools that kind of serve as the foundation for the rest of the course. From there, you learn about forecasting and different methodologies for assessing future performance, a few methodologies for valuation, and then using all of these lessons to understand how financial analysis tools apply in actual strategic decisions like mergers and acquisitions and spinoffs. The course is 8 weeks long with a 5 to 6 hour time commitment on average per week. I think we're running a cohort right now with the next one starting on October 22nd, and an enrollment deadline of October 16th. If you're interested in learning more, you can check out our website. And also just wanted to briefly share that this course is part of our finance and accounting topic area. So if you're already taking strategic financial analysis, or if you're not sure if it's the best fit for you yet, feel free to check out our other courses here. If you take 3 courses in the same topic area in 18 months, you're eligible for a certificate of specialization. Strategic financial analysis is one of our most rigorous and analytical courses. We consider it to be a little more intermediate level and maybe a bit easier to follow if you're coming in with some basic finance and accounting experience. So if you're new to the topic area, if you need a refresher, you might be interested in starting maybe with one of our beginner level courses. And then I think this course builds on it really nicely and helps you understand financial analysis at a deeper level. So with that, I will introduce our guest today. I'm thrilled to be joined by Professor Suraj Srinivasan. He is the Philip J. Stomberg Professor of Business Administration and a member of the Accounting and Management Faculty Unit. He also co-leads the HBS MBA program as the chair of the MBA elective curriculum. And as I mentioned, he recently developed the HBS online course, Strategic Financial Analysis. So thank you, Suraj, for joining us today.
Oh, totally my pleasure. And thank you, Julia, for hosting this and inviting me. I'm really looking forward to it.
Yeah, thank you again. I think this will be a great discussion. As I mentioned, I have some questions here, but feel free, everyone, to submit other ones as we're going through, and we'll try to get to as many as we can today. I'd love to start out and just to help everyone understand what exactly is strategic financial analysis and how does it go beyond financial statements, like an income statement or a balance sheet, to provide insights that actually can drive business strategy.
Great opening question, Julia, and that's the whole premise of the course. Is what do we? So the answer I have, the way I think about the question that you raised, Julia, is that we do financial analysis for a reason, and so the question that we look at throughout the course is what are we doing the analysis for? What are the set of questions that we want to ask? And so we root whatever analysis that we do in the business model of the organization, of the company, of the business that we are trying to think about, that we're trying to analyze. Every business has some basic business economics that drives the risk in the business, that drives the rewards, the opportunity, how a business makes money, how a business, what risk does it take in making money. So that's why we call this strategic financial analysis and not just analysis of financial statements. Financial statements provide us with the data to do the analysis, or actually one source of data, there are other sources of data as well. Financial statements are the source of data. Then you use that data to answer some set of questions. You answer questions about how well is the firm performing, or you can ask questions about how much is this company worth, how much is this division worth that I'm trying to buy, how should we perform if we had to achieve certain expectations. So there's so many different kinds of questions. How did I perform this year compared to last year? How did my Asia business perform compared to my North America business? And so all kinds of questions that can be asked. The financial statements are an important source of data. And so unless we get a good grip of the business itself, the strategy, the business model, we will not be a good analyst. Tries to start with the underlying drivers of the business, the underlying strategy, and then looks for what data will help us answer those questions. And that data very often would come from the financial statements.
Thank you. That's very helpful. And I saw we had a question come in live as well about what roles financial analysis plays in linking strategy to measurable outcomes. And I think you answered a lot of that just there, but any other specific examples of how you can link strategy to measurable outcomes with financial analysis?
Oh, that's a great question. Now, if you think about any business, any organization, an organization carries out a certain set of activities. It collects resources, people, financial resources, puts those resources into action through a manufacturing process, service process, and then gets to some results. If, let's say, you're an investor and you're trying to figure out which of these set of businesses should I be investing in, or which of these set of businesses that I'm already invested in are doing better than one another. So the financial and so therefore you are interested in outcomes, but which outcome? Should it be a long-term outcome, short-term outcome? Is it an outcome related to overall performance? Is it an outcome related to a certain aspect of the performance? So, for example, is it related to how well am I selling, or is it related to how well am I managing my cost? Is it related to how well am I managing my advertising expenses, for instance, or advertising program, for instance? So there are any number of larger and more specific questions that can be answered, and that's the process of financial analysis. Is this sort of linking what the business is to what the outcomes are, and how do we do this analysis? How do we do the analysis compared to how the same business was doing last year, let's say, so a time series. Or you can do an analysis of how is company A performing relative to company B, so cross-sectional analysis. So that's the process of financial analysis, trying to link strategy to these outcomes. Julia, you're muted.
Sorry about that. Thank you. Yes. So I know in the first module of the course gets a lot into this. It talks about the links between financial results and strategy. It goes through the example of Netflix and how their financial strategy is reflected in their financial statements. So I think that's all really helpful to understand. But in the second module,
as you know, we have some really interesting examples in that module with Netflix For the people who have already done the course, you would have seen it, and I love some of those. I love some of those examples and the cases that we have there because I mean these are products and services that we use. These are companies that we read in the news and are familiar with. What excites me when I started teaching this material now many years ago, what continues to excite me with this topic is how understanding financial analysis, strategy analysis, accounting numbers, financial statements makes what we see in the world around us very kind of real. Suddenly it feels to me that my way of looking at business, I have a new language. I have a new way of thinking about of understanding news and understanding what's happening. When a company says we're going to do X or Y or Z, I'm suddenly able to start thinking about them in a way that I wasn't before. I'm thinking about, oh, this must mean that this is how their performance is going to change. This is how their assets are going to change. This is how, so any number of those things. You start putting some more sophisticated lens to the stuff that you see around you in the world.
Absolutely. Yeah. I remember from the course, it gets into things like that I'd read in the news about Netflix pivoting from DVDs to streaming. And so seeing how that actually reflects on financial statements is something you may not know about just from reading the news, but it's really interesting and valuable to start thinking that way.
And that's the aha that I get from everybody, from the students in our MBA program or others, is that very quickly, a couple of sessions in, they are like, wow, like I didn't realize that numbers are basically another language to describe business and describe business activities, and it's always fun and gratifying to see early users like that light bulb going off and them saying like, wow, like I can do this now.
Absolutely. Yeah, it really is the language of business, I think. I want to pivot a little bit to, so a little later in the course, it gets into the traditional DuPont ratios. And so my understanding is that this is a series of ratios that basically assess a company on 3 levels. So there's profitability, there's efficiency, and there's leverage. So I was hoping you could maybe talk a little bit about why those ratios are important, and also how do you think about whether a particular metric is good or bad for a particular company?
No, yeah, great. So this DuPont is a company, and the reason it was called DuPont ratio is this DuPont corporation more than 100 years ago sort of invented. I'm sure it was in existence even before that, but they kind of put this nice framework out. This structure of ratio analysis you talked about profitability, efficiency, and leverage. So margins, asset utilization, and financial leverage as 3 levers of how you can drive performance in a business. So think about it the following way. Margins is essentially sort of the profits that I'm making. A business is spending some cost, it gets some revenues, and that difference is the profit. So that's one dimension of performance. A second dimension of performance is a business has some set of resources, assets, and generates revenues, generates output based on those set of assets. How well do I use those assets to produce the output? That is efficiency, that is productivity. So the first piece is margins, which is how much am I making over my costs? The second is how am I using the resources that I have, the assets that we have. And the third is how does my capital structure, how does the fact that I have equity and debt, a company could be all equity, another company could be more debt than equity. And even if that, so let's say somebody has $100 or €100 or whatever the currency, it could be all based, all equity, so all owned by the owners. Another one might be 50-50. And so how does that financial structuring change the the way the company is performing. So it's a very elegant, simple framework. How am I doing in terms of cost and revenues? How am I doing in using my assets? And how am I doing in terms of using own capital and borrowed capital? And with these three ratios, margins, efficiency, and financial leverage, you can tell the story of where the performance is coming from. So, for example, if there are two companies and they're performing identically on some overall metric, let's say return on equity, it could be that one of them is a very high margin, sells premium products, and does a huge amount of value addition, and therefore gets a lot of margin. There could be another one which turns its assets over really rapidly. So they make less margin, but they are very efficient in how they use their assets. The net result might be similar return on equity, but they are getting it in different ways. So the business strategy is different. And that's why decomposing and understanding these ratios helps us understand better where that performance is coming from. So that's why I really love the idea of ratio analysis as a part of financial analysis, because it's now lets you understand. It's like the analogies of peeling the onion. You see the whole onion and you peel layer after layer after layer, and then you understand more and more what is actually causing this, what is the difference, how our company is similar, how our company is different, and that's what this ratio analysis gives. You can see the professor in me, Julia. You ask a simple question, and I give you a very long answer.
I love the onion analogy. I think that's very fitting here. And I see we've had a few other questions come in that kind of build on what you're talking about. So I want to just pause and introduce those here. So we had one question come in about how we can distinguish a company that looks financially healthy in the short term but isn't sustainable in the long run. And then we have kind of a related question around how can companies balance short-term financial performance with long-term strategic goals. So I wonder if you could kind of speak to both of those, that tension between short-term and long-term performance.
I will try a 1-minute answer. Really, the answer is take the course. Because these are fantastic questions. Thank you for asking them. How do we distinguish a company that looks financially healthy in the short term but isn't sustainable in the long run? Look, this is the question that every financial analyst tries to answer. And the trick is really understanding what does current performance signify about long-term prospects of their performance. So some simple ways are to assess if there are short-term sources of gains in current performance. So, for example, if a company is selling some undervalued assets because they're getting rid of a division, they're selling some division or that's been depreciated and so on, and those are one-time sources of gains that one should not overestimate as if it will stay for the future. There are other slightly harder places where which get trickier to estimate. So, for example, if you have launched a new product and there is enormous early traction in that new launch, it might appear as if the profitability is really high. However, we know that any strong performance attracts competition, that high levels of current margins do not mean high levels of continuingly high margins. One of the tools that we introduce in the course, or ways of understanding that we introduce in the course, is what we call mean reversion. Any high level of performance typically does not sustain into the future. If it does, or if you expect that it does, you should ask the question. When you do the course, you will see you know this, Julia. You see this graph of mean reversion. So if a company starts at a high level of performance, typically their performance reverts to the mean. And so if I'm projecting that a current high level of performance is going to stay high into the future, I have to ask, why? Is it because of a strong brand? Is it because of some competitive mode? Is it because of some innovation or patent that this company has, or some capability like terrific employees and a great culture? What will cause something that is abnormally high or a supernormal level of performance? What will it cost it to stay high in the future? It is very rare for that to happen. And so, questions like that we explore in the course are really the tools that a good analyst uses to assess whether current high levels of performance will actually continue into the future. In fact, that is one of the mistakes that analysts make, is to assume that a high level of performance today implies a high level of performance well into the future. And so they will take a current high level of performance and project it as if it will keep growing or it will stay stable. In fact, the reality is that there is a reversion to a lower level, which is the mean level of performance in an economy. Great question.
Yeah, thank you. And I think this ties a little bit to the idea of forecasting, which is something else in strategic financial analysis. There's a whole module about it. I'd love to get your thoughts on so we talked a bit about mean reversion, but what are some of the most important factors to consider when you're forecasting? And in particular, we had a great question from a learner about how global issues like inflation and higher interest rates and geopolitical uncertainty, how does that affect the way that we think about forecasting and trying to guess what future performance might look like?
No, that's again a great question. First of all of the above, exchange, geopolitics, supply chain issues, tariffs today, things of the sort, like all these things will affect how we forecast. There are two, when in the course we do this, but think about forecasting in two horizons. One is a somewhat shorter term, and then the other is the longer term. As I mentioned, typically in the long term, the companies tend to perform at some economic rate of growth that is unique to that is particular to that industry or to that country. It is hard for especially larger organizations to systematically beat a long-term economic rate of growth. So if the GDP growth in the US is whatever, let's say 4 to 5%, it is hard for a Walmart or a Home Depot or any large company to systematically be significantly higher than these long-term patterns in the economy. And so every country, every industry has these long-term patterns, and every good analyst will benchmark the longer term with these patterns. And then ask the question, is there a reason for my company to beat this? So if a drug company, if a pharmaceutical company has introduced a new patent protected medicine, then you might say for the next 10 years, or next 5 to 10 years, you might be seeing an abnormally higher level of growth because of this new drug that has come in, which is patent protected. But for a stable company without something like that, it might not be reasonable to expect that there's going to be a high level of. So that's in the longer term. In the shorter term, many of these forecasting questions become very specific to the particular circumstances of that company. Like I said, has there been a new drug introduced? Is there a new factory that has come online, and because of which there's going to be better production and so on. When you think about overall valuation, it turns out that the impact of the short term is actually fairly limited, because we're valuing a business on a going concern basis, on a steady state cash flow, discounted cash flow over its lifetime. The impact of 1 or 2 years is somewhat less compared to the overall life of the business. So even if you aren't that perfect in the short term forecast, the fact that you are better in the long term forecast gives you the ability to actually do better overall in a forecasting sense. But the broad answer to your question is, in the long term, look for broader patterns of how an economy is doing. in the short term, look for specific idiosyncratic company-specific information that is going to drive how that particular organization, that particular business is going to perform.
Thank you. I think that's great perspective on the art of forecasting. I
It is an art. You use the right term. Like, we try to make it as much science, but there is a lot of art. And the best forecasters know the business really well, but they also follow a very disciplined process to ensure that we don't make mistakes. For example, like the previous question, taking current high levels of performance and imagining that that current high level will stay high into the future.
Absolutely. I want to pivot just a little bit on this next question. We got a great question that came in about AI technologies, and I know this is not covered directly in strategic financial analysis, but I think it's a super interesting question as we look ahead maybe toward what the future of strategic financial analysis looks like. So I'd be curious to get your thoughts on how AI technologies such as machine learning, natural language processing, how are they currently or will they transform the financial analysis space? And what kind of impact are they going to have on investment decisions and long-term value creation strategies?
Well, again, we need a whole webinar or a whole course to answer this question. These are amazing questions from the audience, from the folks who are taking the course or are interested. By the way, you probably know this, but I spend a lot of time. I'm currently teaching a course on AI. I spend a lot of time thinking about AI issues and do a lot of research on the topic. I'm right now testing a few different tools. We are, cloud for finance, several tools for our own MBA program, but also perhaps in the future to maybe create a module on using AI for financial analysis for our course. But you asked two things. Actually, the question has two parts to it. One is, how will AI transform business? And therefore, as an analyst, how do I assess the value of a business? How do I do forecasting and so on? That is more a strategic question about business itself and how business will change and because of AI. Let me put that question aside for a moment, because it is a strategy question about the future of business. And my sort of simplistic answer to that question is, just like you do strategy analysis for any technological change, like we said, for example, Netflix wanted to go into streaming and then went into streaming, or Netflix decided to produce its own movies. And so, all those technological changes in the business model would have a certain impact. AI is similar to that. The question in chat is a little more specific about using AI as a tool for financial analysis in itself. And I think there are two very, very interesting implications, at least two very, very interesting implications. In the interest of time, let me just stick to those two. One is, we are talking so much about strategy analysis. We are talking about how will this business behave in the future? How is this business doing with respect to competitors? How do I compare Coke and Pepsi? How do I compare Unilever and P&G? How do I compare Amazon and Netflix and so on? Amazon Prime and Netflix and so on. A lot of that work, if you have tools like Deep Research, Perplexity, or Deep Research on Gemini or anywhere else, the data collection, the information collection task, and conducting a strategy analysis, conducting a strength, weakness, opportunity, threat, SWOT, conducting a 4 to 5 forces, blue sky analysis, any kind of strategy analysis becomes a little, you have now tools. You have a personal research assistant. I was having a detailed conversation with the head of AI at McKinsey this morning, and talking to them about how they are thinking about adopting, and how they are not thinking about how they are adopting AI in the business, and they are a top strategy consulting business in the world. So AI is very, very useful in doing that strategy thinking, or becoming a support, a tool to help you do the strategy analysis as part of doing financial analysis. That's one piece. The second piece is a lot of the tools a lot of the analysis that we will be doing can also be done. You got to be a little more careful. The newer reasoning models are better. Traditionally, the older, like a year or two ago, if you had asked me if you had done some ratio analysis on ChatGPT, you would have probably gotten wrong answers. Today, the state of the technology with reasoning models is so much better. With code gen is so much better. So the second piece of it is actually doing the analysis. But that piece of it is essentially something that you could have used some other software for, Excel for. You still need to know what you're doing. You still need to know why you're doing the analysis you're doing. You still need to know what the ratios mean. How are you going to interpret those ratios? So AI tools can become useful helpers. You are still the brains that knows how to use these tools. You can, for example, Julia, go and say, give me a DuPont decomposition of Target and Walmart. And any of these tools will give it to you. First of all, you got to know whether the analysis was done correctly. And secondly, as in our course, you need to know, you will be the one who's interpreting it. And that's what we focus on in the course. And that's what I like to focus on for myself is how do I interpret the analysis that is produced? Because that's the higher order work. Actually doing, but getting your hands dirty and doing the work is important, because only then do you know how to analyze what that financial analysis means. If you don't know why you do DuPont or any number of ratios, then you will not be an informed, you won't be a high quality user of that analysis. So use the AI as a tool, both for strategy analysis and for financial analysis, but you are the interpreter, you are the orchestrator of whatever or whatever the answers come to you.
Thank you. I mean, we could spend a whole webinar talking about this, because that is really fascinating how that space is evolving and shaping how we might approach financial analysis. I see we have another learner submitted question that I want to make sure we get to, about what financial metrics are most persuasive to demonstrate business value and strategy and execution. So I'd love to get your perspective. I'm sure that's another big topic and maybe a little industry dependent.
It's a wonderful question. It's a very contextual question. So I'm not sure we can give a really precise answer here. You got to know. So maybe let me illustrate it with an example. Let me take two examples from the course. Now we've talked about Netflix as a case that we use in the course, and one of the things that we do in Netflix is, when the company initially moved into streaming, there was a lot of questions about how well will you be doing in streaming, and that was the question the analysts were asking, and so the answer would be, how do we answer that specific question? How do we answer the business model is changing from what they were doing before to what they're doing now? How do you tell that they're actually going to do well in this new business? And so there will be a set of metrics that tell you how well the company is doing in that. So for instance, because in streaming they were starting to own a lot of their assets, a lot of the shows and movies that they were creating or that they were showing. It meant that suddenly the company was going from an asset light model to an asset heavy model, which meant the asset-based ratios became more important to make that assessment. So are they actually giving a return on the assets? Previously, they were an asset light model. It did not matter how much of capital that the company was having. So a set of metrics around asset utilization, a set of metrics about how much they were borrowing became very, very useful. Another example we have in the case in the course is this company called BWX Technologies, which designs and manufactures nuclear reactors for U.S. Navy submarines. They are doing a lot more with nuclear products now. and they've created 4 or 5 other newer divisions. However, because these were newer divisions, more innovative, there were a lot of questions about how well are these newer divisions performing. And so in those cases, in that example, you needed some forward-looking metrics. So you needed metrics about customers. For example, if there is a nuclear medicine, was a new division, they were starting to produce metrics about how many new customers are signing up, how many hospitals are signing up. If there was a nuclear power generation plant, what are the success metrics in that business? So again, I'm trying to give some examples because this is a very broad question. Essentially, the answer is that you have to, going back to the very first question that we have, like, how do you link strategy to measurable outcomes? And so that's how you come up with the metrics, is to figure out what those measurable outcomes are that will tell you in a leading way whether this new approach or this particular product or division is going to be successful. So what are those measurable outcomes that will help me assess how well this management team is executing? Yeah, I know that's not a. We'll need to get very precise about specific businesses to be able to really answer this question well.
Yeah, thank you for the nuanced answer. I think that's a helpful helpful way to think about all of that. And so I'm trying to be mindful of the time here, but I would really love to get your thoughts. So I know the core strategic financial analysis, it's a good fit for anybody who is working in that analyst world. So you're looking at company performance and comparing it and trying to assess future performance. But I think it's also valuable for kind of that inside audience of people who work within companies, especially as senior decision makers. And some of those people who are maybe making those strategic decisions may not have a finance background initially. So I wanted to get your thoughts on, for somebody without a finance background, how accessible is it and how important is it to be able to learn some of these financial analysis skills that we've been talking about today?
I trained as an engineer. My undergrad was in engineering. I never did finance until, I don't know, very late or somewhat late in my career. But I was always in business, after my MBA. So my answer to that question is, it's the course, and again, we started out with this idea that it is about the business. It's strategic financial analysis. It is about the business model. It's about the questions that we want to answer about what should we do in the business, how well are we performing. The finance is the data, the financial statements. You asked me a question about financial statements and how strategic financial analysis goes beyond financial statements. The financial statements is just the data. Numbers help us answer the questions, but the questions are of a business nature or of a strategic nature. So I would say that anybody in business, and folks in business already know this, is in any line of work, in any functional line, whether you're in marketing or supply chain or advertising or product management or technology, eventually you are dealing with metrics. Eventually you are dealing with how well is this product doing? How should I price something? How well is this division doing? How well is this region doing? And actually, I would wager, I would contend that a program like this, a course like this, is actually more useful to business people than somebody who is already a financial analyst or a financial expert. A financial analyst or financial expert has to do this, and so the tools are sort of immediately useful and practical for them. But a business user needs to do this. A business user is so much better off by bringing a data based lens to their work. And the data that we are using here is financial data. And so developing that instinct and intuition, you call this an intermediate course, and that is right, because there's some language that we use here that somebody has to know. But I think that is the language of business. That is, revenues and expenses and assets and liabilities. These are things that we kind of is common parlance in business. And so to put a little structure around it helps the non-finance person in business actually become so much more business savvy, not just finance savvy, but business savvy.
Great, thank you. I'm just looking through the question list here. I know we've covered a lot of ground. I did think there was one other learner submitted question that had come in the registration that I think might be kind of fun to end on, about book recommendations, maybe in the world of finance or otherwise. Would love to know if there are any books that you recommend as we're kind of closing out summer here and maybe heading into back to school season.
Well, yeah, I saw that question. So if you have wait for my book, or but I wish there was a book that we had that we had to go along with the course. But there is an interesting good book on valuation by McKinsey and company that is sort of complementary. That if somebody wants to dig even have as a companion once you do the course, that might be it's called Valuation by McKinsey. That's an interesting one. But more broadly, what books would you recommend in today's world? Like I said, like I'm spending so much time on artificial intelligence. So there are several sort of very, very interesting ones on the topic. There is one by Mustafa Suleyman from Microsoft on AI. In fact, he has a couple of different books on AI. Sticking with Microsoft, if you want to go back a little back in time, tying it to our valuation topic that we've been talking about. If you read Hit Refresh by Satya Nadella, the CEO of Microsoft, it walks you through how the company changed and pivoted when he became CEO. You might remember that Microsoft, how well Microsoft is doing today was not a foregone conclusion back in 2013, 2012, when the company was actually sort of a middling performer, and then they got seriously on the cloud strategy, and now on the AI strategy. And so that's an interesting book that describes the strategic shift and the culture shift, which if you juxtapose on the valuation question, I love transformations and change. And transformations and that book is a great one on how a large organization transformed and changed, because it's very interesting when you are at the moment of transformation and change. How do you ask questions about forecasting? If in 2013, 2014, what would you have forecast for Microsoft? How would you have forecast the future of Microsoft at that point? How much risk would you have put on it? So read that book and think about the valuation course, and think about how you would value a company in the middle of transformation. Somebody asked this, you asked me this AI question. That's a great question. If you read Hit Refresh and if you read Mustafa's book, think about how you will answer Julia's question about how will AI transform businesses, and what should that mean for how will we forecast future performance and value these businesses, value businesses today. So I'm trying, Julia, to tie all these things together and bring it back to our valuation topic that is here. It is a fascinating moment in time to think about forecasting and valuation in the middle of massive technological change. I think you had pointed out to me, or when one of your colleagues had, that a lot of the cases that we have in the course are actually technology companies. In fact, probably all the cases that we have in the course are technology companies. We have a comparison between Intel, AMD, and Intel, TSMC, and NVIDIA. TSMC, the Taiwan Semiconductor Manufacturing. I mean, that's a fantastic story of how technology has how the AI revolution has sort of changed the fortunes of these companies. So anyway, I'm digressing from the book question into larger elements, but I'm super excited about just change and transformation and how that then, as an analyst, as a business leader, am I going to assess, understand, analyze, and value that change?
Thank you for the great recommendations and for tying it back to valuation and forecasting. I feel like we could talk about this stuff for hours, and we barely scratched the surface with some of it. It's also in depth, but I know we're past 4:15 now, so I just want to say that this has been such a great conversation. I think we have even more questions we haven't gotten to, but we've covered a lot of really good ones. So thank you again for your time and for sharing your perspective on all of this with all of us here today. And thank you to everybody too for joining us today. I hope that you learned a bit more about strategic financial analysis. And as I mentioned at the beginning, we do have Suraj's course, Strategic Financial Analysis, available on through HBS Online. So if you want to learn more, you can check that out on our website. But yeah, thank you again. This has been a great conversation.
Oh, my pleasure is entirely mine, Julia. Thank you for hosting this. Thank you to HBS Online for the course and also for this event. Happy to continue this discussion. I know this is going to be posted on various social media, so happy to continue that conversation, continue this discussion on those forums.
Great.